Hello, everybody. This is Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool, a.k.a. Mr. Valuation. This is part 3, my final part, of the update on 3 portfolios I built on August 24th, 2021, and promised that I would track them as time went on. Now, each of those portfolios was designed with specific objectives to meet certain clients' needs. In part 1, I talked about a client who just needed current yield, but also wanted to control risk to the maximum extent possible. In number 2, I looked for the client who was maybe younger, who was looking to build a dividend growth portfolio, but also wanted to see the dividends grow very fast so that when they got to retirement age, the portfolio would be big enough and have enough income for them to grow. Now, in this part 3, I'm taking a look at a portfolio where I overweight 5 or 25% of the portfolio, 5 of 20 stocks, and put them into high yield companies. Now, I want to say something about it. This was to get maximum income out of the portfolio, but still try to deal with risk at the maximum extent possible. In other words, it was less diversified than any of the other portfolios because it had so much of a weighting in each. The 5 stocks that it had overweight had $100,000 investments for $500,000 total, or half of the total portfolio. And then the other half of the portfolio, the other $500,000, was spread equally amongst 15 additional stocks. The idea is to get the highest current yield we possibly can. Now, let me say something about performance and how a portfolio like that would be expected to perform. Common sense would tell you that the higher yielding stocks tend to be the lower growing stocks. But valuation can also come into play, as I'll show you later. But nevertheless, it might not actually grow as fast or grow the dividend as fast, but they will produce the maximum income. Now, none of these portfolios, including this one, was actually designed to beat, so to speak, the S&P 500. Although, interestingly enough, all 3 of them have so far. But it's a close race with some of them. But the point is, they were all designed to produce a lot more income than the S&P 500 was capable of generating for a share for a person. And they've all done that. They've all met that goal. So the whole idea here is a focus on dividends and dividend income, not trying to beat markets, but by applying the valuation principles that are so important, these portfolios all perform well. So here in this video, we're going to look at part 3, the overweight portfolio for maximum yield. So let's go into the new FastGraphs stock portfolio performance report and look at how these stocks have actually fared. So here's the report on the new FastGraphs stock portfolio performance report. The reason I keep saying stock, for those of you who are subscribers to FastGraphs, this isn't going to show any of your other holdings like bonds or CDs or even cash in your account. This is strictly the money that's in the market, that's already invested in stocks. All right, this goes from August 24th, 2021 to April 4th, 2024. That's this time frame. Now, this changed a little bit from my first video because, like yesterday, this portfolio was down $814. All right, originally started with $1,035,000. That's as close to $1 million as I could get. All right, the portfolio has generated $127,000 in income. The S&P has been in the 30,000 range, so this is going to be almost 4 times as much income as the S&P. The current yield in this portfolio is 5.10%. And that was the idea, to get the maximum income out of this and not have any real great losses. And by the way, we actually had stocks in the portfolio that did reduce their dividend, but yet we still generated a tremendous amount of income, and we're outproducing dramatically on the current yield basis. You know, we got a little over 1.25% in the S&P right now, current yield. Here we're getting over 5%. Now, when you look at the holdings, 82% large cap, 17.7 or 18% mid cap. And these are all the holdings where you can look at the dividend. You can point to any of these and it tells you the dividend yield, the estimated growth rate, the portfolio weighting. Now, I want you to notice this was one of the 5 high yield stocks that we put in $100,000 rather than $33,000. So its weighting is currently 13%. Now, here we are repeating the weightings. Now, interestingly enough, in this scenario, I just thought this was pretty fascinating when I looked at it. If I look at Cardinal Health, it's actually 6.9% of the portfolio now, but it was not overweight in the portfolio. It strictly happened, as you'll see here when I go through it, because it grew so much. Now, the next thing I want to do is go through the holdings here. And the holdings give you a lot of information. They give you the weighting, so you can almost just eyeball this and see the ones that were overweight versus the ones that weren't overweight. And it was the high-yielding ones that were overweight. We look at the gains and loss column is another important column. Now, you can look at all these columns, but the gain and loss column is important. By clicking on the heading, I can order it and top to bottom. So the biggest gain has come from Cardinal Health. That's why it's such a high level in the portfolio. But that was followed by Enterprise Products, which actually was one of the overweight stocks that went in. Now, this portfolio does have several stocks that are showing losses currently, but they're unrealized losses. These stocks haven't been sold, but there actually are a couple of the companies in this portfolio that have real problems. WBA is one example, and I'll go through that as I go through the portfolio. It has problems with both profitability dropping, but also the fact that they cut their dividend. UGI is one that's down quite a bit, but the fundamentals have been actually good. They've been flat, but they've been strong enough to warrant a much higher valuation, and it does throw off a nice dividend yield. So let's go get into these, and I'm going to go in alphabetical order as usual, just so it's easier to track that way and easier to follow for you. So I'm going to start with AbbVie. And once again, we bought it on August 24th. It had a little drop, but then it's been performing really well since. And we see that the dividend has been growing tremendously. Now, we can calculate the performance here by doing a couple things. I want to shorten the time frame to 6 years. I'm going to allow any dates. I'm going to go in here and I'm going to hit the calendar button. And I'm going to go to August of 2021 and then go down to the 24th, because now this gives me the precise time that we're investing. Now, I've also done that for the S&P 500. So I want you to go look at the performance of the S&P 500 just as a benchmark. The S&P 500 has generated a 7.13% rate of return, and it's thrown off about just a little over $36,000 in dividend income. So that's your benchmark. We'll call it $36,000 in income, 7% rate of return. All right, going back here now to AbbVie, if I go into the performance report of AbbVie, I see that AbbVie now is the blue line and the orange line is the S&P. You can see that AbbVie's done better than the S&P in terms of price performance, and it's also been done it at a lot less risk because it's been low in valuation relative to its blue line, versus the S&P, which has been overvalued relative to its orange line. These are the intrinsic value lines. Now, AbbVie generated a 16.36% growth, or capital annualized rate of return of growth. The capital appreciation, which is 5.65 for the market, and then it gave us total of 1991 versus 689. We have a slightly different date here. We got August 27th instead of August 24th, so that's why. But it's still, we're going to call that 7%. Versus 19.9% total rate of return. All right, now I'm going to spend a little time on this one so you understand, but I'm going to go faster as we go through. So now we're going to go to Amgen. You can see Amgen has performed very well. The gold line represents our cost basis. And here I can just real quickly calculate performance. We've done 11%. Growth has been, average rate of return without dividends has been 8% versus about 6% in the S&P. So slightly outperformed. We got 11% total versus 7% in the S&P. So Amgen's been a very good performer for us. Franklin Resources has been one of the weaker ones. We're slightly losing a little bit of money here, but if I calculate the performance of this one from the time that we started this portfolio, it's actually got a negative rate of return, but it has thrown off a significant amount of dividend income relative to the S&P, and it's beginning to catch up. Again, I think you shouldn't even measure these portfolios for 3 to 5 years. This has been about 2.5 years, and the longer the better, because it takes time for companies to generate good returns, and value is important. Now, Cardinal Health is interesting. You can see that Cardinal Health has been just an incredible performer for us in this short period of time. It's averaged over a 36% annualized rate of return. Its appreciation alone has been 33%. And then with dividends, it's been 36.18%. So we've got a significant more dividend income off of this than we did the S&P, but we also got tremendous outperformance. So that's your Cardinal Health. And as I promised, I'm going to go quicker now. Chemours is another one that's slightly underwater, one of the red ones. but it does have a 3.48% dividend yield. And so when I calculate performance since inception, it's underperformed the market, but it's thrown off more dividend income. So I want to make that clear. So it still has a way to go to beat it on a total return basis, and it's still got a moderate loss to it, but it's beginning to move back into alignment with its fair value, which would be up here in this orange line. Eastman Chemical is underwater as well, but you can see it moving strongly back to fair value. We did have a couple of years of negative earnings, but we've got a good dividend yield. And I want you to notice the dividend increased each year. And this one, if I go into the fair performance report here and compare it with this S&P 500, we generated just under twice as much dividend income as you got from the S&P, but it's clearly underperforming the S&P at this point. But it's still holding its own on the income. Remember, these portfolios were all about income. So let's go back into the historical graphs and let's move on to the next company. Enterprise Products was one of the ones that we overweighted. If I look at it from a performance standpoint against the S&P, it generated way more dividend income, about 2.15 thousand versus 355. Significant outperformance on annualized rate of return, significant outperformance on total rate of return. Enterprise has been a real winner for us, and it's really helping the portfolio a great deal. Now, I'm going to just go a lot faster now. HPQ is about breaking even, but it's currently got a 3.72% yield. It's still way undervalued compared to the overvalued S&P 500. Let's revisit that real quickly because I think it's important for you to see that the S&P 500 is trading at over a 24 multiple, and yet if I look at HPQ, the symbol, and it's trading at an 8 multiple, almost not quite, but a third of the valuation, and yet it's holding its own. Ingredion has been a good performer since we bought it. It's yielding 2.73%. JPMorgan has been a very good performer. Philip Morris, or Altria is the real name, it's been a little bit underwater, but it's thrown off a lot of dividend yield. It's generated a positive rate of return, but it's really thrown off a lot of income. If I go look at the performance report here, compared to the market, you can see 1.88 thousand versus 355 in the S&P. So it's significantly producing more income than the market did. So it's helping our income portfolio. Moving on, if I go to Merck is outperforming. It's got a decent dividend yield when we bought it. Omega Healthcare has been outperforming with a 8.58% dividend yield. From a standpoint of total return, we're a little bit underwater, but we've averaged 5.18 versus 7. And the point is, though, we've generated significantly more income, more than triple the amount of income off of this stock. The next one was OMC. It's performing very nicely. Earnings are growing very nicely. It still only trades at a 12 multiple, offers almost a 3% dividend yield, and a really strong earnings yield still. Principal Financial Group has done extremely well. Now, this is one of the ones that's gone down in value. Significantly, we're only using an 8.89 market using the Graham-Dodd formula, but if I looked at this at a 15 multiple, the stock could give us significantly much higher returns going forward. And if I looked at a 15 multiple for the current period of time, we'll call it, it's worth a lot more than it's currently trading at. Well, this is going out to September of this year, and it's a $43 stock that's trading at 24. I like this stock a lot for the income, yielding over 6% dividend. VICI or VC, or however you pronounce this one, is a REIT. They own real estate in big casinos and so on. And this one has been performing about average, but it's throwing off about 5.65% dividend yield. If I go to the transactions file here, this is one that we put $100,000 in. So we overweighted this, and we overweighted it because of the dividend of over 5%. So moving on, Verizon is kind of going to par. Again, I'm using a lower PE ratio because of the Graham-Dodd formula with low growth. But if I went to a 15 PE-ish, it has tremendous upside potential long term. It's yielding over 6%. And if I go into transaction file, this is one of the ones that we overweight. And then Walgreens Boots Alliance now is one of the ones that's really performed extremely badly. But I want to basically explain why this stock is performed badly. Okay, first of all, this would be a mistake, and I'm going to look at it from a standpoint of about the last decade. Okay, I want you to note that earnings have been dropping. They were dropping here, but they were expected to recover. And if you go back to the original video, earnings growth was expected to be much stronger, but it didn't happen, and this company did cut their dividend. So we've had one dividend cut in the portfolio, but yet getting back to the summary section of the portfolio, we've obviously thrown off an enormous amount of income, and we've actually had a 20% gain in the overall portfolio, and it's thrown off $127,000 of dividend income that was assuming to be paid out and spent. So it's meeting the objectives it was designed to do. Anyway, this is Chuck Carnevale, co-founder of FastGraphs, Fundamentals Analyzer software tool. Hope you enjoyed this video. This was all about designing portfolios to meet specific needs and specific investment objectives. And that's, to me, what investing is all about. This idea of always trying to beat the stock market is kind of foolhardy because the stock market is not always the right place for you to be. It might be taking too much risk. Valuation risk right now is huge in the stock market, for example. Doesn't offer enough income. A lot of the stocks in it don't meet your goals and objectives. They don't pay dividends, or they're very erratic. And by the way, the S&P has had stocks that have lost. But anyway, this is just showing that a diversified portfolio, reasonably well constructed, just bought and hold, unmanaged. These portfolios are all being unmanaged. As I said before, the old Ronco commercial where you set it and forget it. But yet they're getting the job done. They're producing the income goals that were looked at, and they still have a lot of time to go on. And even stocks like WBA might end up making us some money in the long run if we continue to hold them. If you liked the video, give me a like, ring the bell, subscribe to the channel, and take a look at FastGraphs. FastGraphs are clearly the value investor's best friend. Thanks for watching.